All right, welcome back. So, if you're deep into your actuarial exam prep, you already know that unit-linked contracts are a massive topic. That's exactly why we're here. We're going to skip all the 101 stuff and jump right into the deep end. The mechanics, the risk profiles, the pricing, basically all the stuff you're actually going to see on the exam.
Okay, so what better way to start than with a real exam question, right? This one is from an old CA1 paper, and it really gets to the heart of it. It asks about the principal differences in the nature of benefits. We're going to use this as our guide. And I'll tell you what, by the time we're done here, you're not just going to know the answer. You'll be able to break this thing down from every angle. So here's our game plan. We'll start with the core principle, then get into the cash flow mechanics. After that, we'll look at the risk equation, do some key contract comparisons, and finish up with a quick exam flashcard recap to make it all stick. Let's get to it.
Okay, first up, the core principle. Let's get right into the one thing that makes a unit-linked contract, well, unit-linked. So here it is in a nutshell. A unit-linked contract is where the benefit you get is tied directly to the value of some fund. Your premiums buy units in this fund, and that's it. This is a huge deal because there's no smoothing, no actuary in a back room deciding on a bonus rate. It's totally transparent. What you see is what you get. Now, that transparency is great when the market's flying high, but it also means there's absolutely nowhere to hide when things go south. It's a massive shift from those old-school conventional products. And this direct link is what makes these contracts so incredibly versatile. Think about it. You can structure them as almost pure protection, kind of like term insurance, or as a dedicated savings machine, or something in between. How? Well, it's all about the ratio of the sum assured to the premium. If you crank up the death benefit, the mortality charges will eat up more of your fund. That's your protection-heavy product. But if you keep the death benefit low, most of your premium goes into buying units, and it becomes all about savings and investment. All right, next section, let's talk about the cash flow mechanics. We're going to follow the money and see how this whole thing actually works under the hood. Okay, to really get this, you have to understand the two-fund structure. It's the absolute engine of the whole thing. You've got the policyholder's unit fund. That's your money, the pot of assets that's going to pay out your benefit. Then you have the insurer's non-unit fund. That's their money. It's where they pay their staff, keep the lights on, and, make a profit. The whole trick, the real magic of a unit-linked contract, is understanding how the insurer gets money from your fund over to their fund. This flow here really lays it all out. So you pay your premium, step one. A chunk of that premium, what we call the allocated premium, is then used to buy units in the fund, and you buy them at the offer price. Now for the clever part. How does the insurer get paid for things like admin and mortality cover? Well, every so often, they just cancel some of your units. They essentially sell them back to the fund manager, but they do it at the lower bid price. The money from that sale goes into their non-unit fund. And that little difference between the price you buy at and the price they sell at, the bid-offer spread, that's one of the ways they make their money. So let's break down all those different charges, because there are a few. You've got your fund management and admin charges. Those are usually a percentage of your fund, taken out by canceling units. Then there's the mortality charge. This pays for the life cover, and it's based on the sum at risk, which is just the difference between the death benefit they've promised you and the current value of your fund. We already talked about the bid-offer spread. That's another little slice for them. And finally, you have the unallocated premium. This is a big one. It's the chunk of your very first premium that the insurer just keeps, right off the top, before a single unit is bought. This is usually to cover their setup costs, commissions, that kind of thing. Okay, let's pause for another exam-style question. This is a really important one. How does that whole canceling units thing for mortality charges actually link the insurance part of the policy to the investment part? Think about it for a second. Let's say the market tanks. Your fund value goes down. What happens to the sum at risk? It goes up, right? The gap between your fund and the promised death benefit just got bigger, so the insurer needs to take a bigger mortality charge in dollar terms. But wait, each of your units is now worth less. So to get that bigger dollar amount, how many units do they have to cancel? A lot more. You see the problem? This can create a nasty downward spiral where poor performance leads to more units being canceled, which makes your fund even smaller. You absolutely have to be able to explain that dynamic in an exam. Okay, so this whole structure leads us to the most important question of all, especially for exams. Who is actually carrying the risk here? And this table just lays it out perfectly. Look, the investment risk, the chance the market goes up or down, is 100% on you, the policyholder. period. But in exchange for taking that on, the insurer keeps all the risks they're good at managing: mortality, expenses, and lapses. And if you get a follow-up question asking why they do this, the answer is simple. They can pull these risks across thousands of policies. They use the law of large numbers, and they build safety margins right into their charges to cover any nasty surprises. They're offloading the one risk they can't predict, the market, onto the one person who's willing to take it. And this is the big takeaway on risk. With a unit-linked contract, there is absolutely no smoothing. Zero. It's not like a with-profits policy where the insurer has a big pot of money to shield you from the bumps. No. Here, the fund value is the fund value. You are directly, completely exposed to market volatility. You get to ride the highs, but you also have to feel every single low in real time.
Okay, so let's put all this into context with some key contract comparisons. This is where we really get back to the heart of that first exam question.
This table is exam gold. Seriously, look at the difference. Unit-linked, risk is on you, the policyholder. With profit, it's shared. Transparency, unit-linked is crystal clear. You can look up your unit price online. With profit, it's a black box. Totally depends on discretionary bonuses. And how is the benefit figured out? For unit-linked, it's automatic. It's just a formula. For with profit, it's whatever the company decides to declare that year. The philosophies are just polar opposites.
So let's go all the way back to that exam question. It asked about the nature of the benefit. Well, now we can answer it perfectly. The nature of the unit-linked benefit is that it's volatile, it's transparent, and it's immediate. It reflects what the market is doing right now. The nature of the with-profit benefit, on the other hand, is that it's smoothed and it's discretionary. It's a blend of past performance, current conditions, and future hopes, all decided by the insurer. Totally different animals. All right, let's wrap this up. We're going to do a super fast recap with some exam flashcards. These are the non-negotiable must-know points. First up, key features. Remember, benefit is linked directly to the unit fund. That means it's highly transparent. This structure makes it super versatile for protection or savings, and it's all built on that two-fund unit and non-unit system. Got it? Next flashcard, the cash flow path. It's simple. Premium comes in, a portion of it buys units. Then, the insurer cancels some of those units to pay for their charges. And what's the benefit? It's just the value of whatever units are left at the end. Easy. Flashcard 3, risk allocation. This is the big one. The policyholder takes all the investment risk, the good and the bad. The insurer takes the stuff they're built to handle: mortality, expense, and lapse risk. That's the deal. And last one, the key differentiator. When you're comparing this to with profits, what's the number one thing to say? It's the lack of smoothing. No safety net. The policyholder is completely exposed to the ups and downs of the market. That is the fundamental difference. So, I'll leave you with one final thought to chew on. Think about this. Under what kind of economic conditions would a unit-linked contract be a really attractive option for a customer? And when would it be the absolute worst choice compared to, say, a stable with profit policy? Think about a long bull run versus a crazy volatile market. If you can really get your head around the why behind a customer's choice in those scenarios, you'll have absolutely mastered this topic.